Alrighty guys, welcome to episode number 7 of the FVG Trading Bootcamp. If you made it this far, congratulations. If you're just starting here, I recommend going back to the first episode, and we're gonna have 20 days, 20 videos, getting into all the information you need to know about not only how I trade, but in my opinion, the important things when it comes to trading. And this is just based on my system and my strategy. So today's episode, we're gonna be talking about inverse fair value gaps. We've already discussed what a fair value gap is. We've discussed how to use fair value gaps, but now we're going to discuss what's called an inverse. And it's, as the name suggests, it's the opposite, right? Now, just as a little bit of a recap, in terms of fair value gaps, we talked about when the market's moving up, right? When the market's moving up, price is going to respect what's called a bullish fair value gap. When the market's moving down, like that, the market's going to respect bearish fair value gaps. Now, there comes a point in time when the market reverses where often we are going to invert one or the other, and I'll show you exactly what I mean. Say you trade the New York session. This was from a couple of days ago on the 23rd of October. We've talked about liquidity. We come down and we sweep liquidity. Now, we know that after sweeping liquidity, we can do one or two things. We can either push through or we can reject. In this case, we reject. As soon as we reject like that with those wicks, again, go back to the very first or the second episode where we talk about the candlesticks and the wicks. You can see how these wicks reject. That is a good sign. We sweep liquidity, we reject. So we're putting multiple things together now. That in itself suggests the market may want to move a little bit higher, and we combine that with what's called an inverse fair value gap to, seal the deal. Now, this, I'm going to mark it out. This here is normally a bearish fair value gap. And if price wanted to go lower, you'd expect price to trade back into this like that, and then you'd expect price to drop back down. However, does price drop back down from here? No. Look at what this candle at 8.45 does. Again, just before a macro, we'll talk more about those. But look what this candle does. This candle actually closes above that fair value gap, and that makes it an inverse or an inverted fair value gap. Now, how can you trade that? You can enter directly off the closure of that candle, or you can wait for the price to trade back into the inversion. Or I'll give you a third one. So you can enter here when we trade back in, or when we push out again. So there's 3 options in terms of how you can enter off an inverse fair value gap. Now, to signify continued bullish price action, we should continue to invert these fair value gaps. Again, if the market wants to go lower, what should price do? The market should trade inside here and then come back down again. But because the market trades into here and pushes through, that is signifying the market wants to trade higher. And the same goes for anything on the downside, right? Anything on the downside, bullish fair value gap should be disrespected. So, for example, have a look over here. The market starts trading down, trading down, trading down. There is a bullish fair value gap right here. And if the market wanted to continue higher, well, you'd expect the market to form the gap, trade into that gap, and then push. Bullish gap. Busy or bullish gap. But what does the market do? It creates the inversion fair value gap, and that becomes an entry. Now, I want to focus a little bit more on the fact that there's many ways to enter from these inversion gaps. Right now, we're looking at the 15-minute chart. Later on, we're going to look at the 1-minute chart. But you need to understand what these things look like and what they mean. I've shown you what they look like. What they mean is a change in delivery. That's all they mean. But what I want to point out is this. There's 3 ways to enter of these. From the candle close is number 1. From the return to the inversion fair value gap, or number 3, the push out from the inversion. What I want to point out is that if you do number 2 or number 3, you won't necessarily always get an entry. If you do number 1, you're almost always going to get the entry. But number 1, you may have to endure some drawdown, and we'll talk about that. So in this situation, assume you went for a short position here, right? Your stop goes above the wicks or the bodies of this high, and we'll talk more about that. Does price return to that inverse? No, price does not return. So if you're waiting for a return, guess what? You miss out on the move. And that's an important point I want to make. What I like to do personally, I like to enter off the candle close. If price returns and rejects number 3, then I'll re-enter the trade up pyramid into the position. The same goes here, right? Look at this. We invert this fair value gap, right? But do we return down here? No, we don't. So it's really important to consider this. We're not always going to return. Sometimes we will, right? And you're going to see these things play out time and time again. So again, we sweep liquidity. We're combining two things together now. We form an inversion fair value gap. In this case, we do return. So you could enter right here, you could enter right here, or you could enter as price pushes. And so you're going to see this in any market movement, right? Moving up, moving down, doesn't matter. In this case, we can do all three. And we can look at bullish and bearish examples, right? Here's another example here. So we do invert this fair value gap. You could enter there, or you could wait for the pullback, enter here, or you could enter down here. All of those entries, guys, are great. Don't think that one's better than another, because the thing is, sometimes the market is going to favor one, other times the market is going to favor another. You've got to choose the one that best suits your trading psychology and your trading system. But you have to experiment with all three. And like I said, for me, I like to enter just as the candle closes. If the price pulls back, I'm happy to enjoy a little bit of drawdown. And if the price pushes down, I'm going to re-enter the position and trail my stop loss. And we'll talk more about that as the time goes on. But this is the 15-minute FVG being inverted. These are some examples, but you're going to see this on all time frames. So the first step is to identify what this looks like in markets. To identify these. To identify how the market forms inversion fair value gaps and how the market usually trades away after doing so. That's the first step. The second step, and write this down. So you want to identify the inversion fair value gaps. The second step is to identify how we sweep liquidity first. This is important. And then form the inversion fair value gap. So you're trying to combine all these lessons we've talked about already. You're trying to combine these things. So for example, start marking this out. We sweep liquidity and then we invert. We sweep liquidity and then we invert. Let's go back. Do we sweep liquidity? No, we invert. Fair enough. So you're going to find examples where, look, we sweep liquidity and then we invert. And those are the best examples to use. If you're curious, those are the best inversions to use. Let's go one step further, right? One step further here. You need to now identify how we sweep liquidity first, yes. How we sweep liquidity first and tap into a fair value gap and then form the inversion. So read that out again if you need to. We're building on from what we've learned, because already we've learned about market structure. We've talked about fair value gaps. We've talked about liquidity, candlesticks. Now we're talking about inversion fair value gaps. But the inversion fair value gap, guys, what you're going to realize that becomes the entry eventually. So you need to understand how all the previous things combine before the entry happens. It's not just looking for an inverse. It's not just, oh, look, we've got an inverse. We're in silver bullet. No. It's about combining the inverse with pre-existing structures to get the highest probability position. Sweep first, then the inverse. Now, let's combine a little bit more. Identify how we sweep liquidity and then tap into a fair value gap. All right, look at this example. We sweep liquidity and price taps into this fair value gap. Again, we talked about 15-minute fair value gaps. Great. In this case, we sweep liquidity. Do we tap into a fair value gap? No. Okay, so you're starting to see things, right? The more of these things you see happen together, the better. The better, right? So this is really important. Now, I'm going to extend on this a little bit further. Let's go back to this example. Look, we sweep liquidity and then we tap into a fair value gap. Those are going to be the best examples. So think of it as a process. Number one is sweep. Number two is fair value gap. Number three is inversion fair value gap. Practice this. Practice this. And we can go back in time, right, and look at exactly the same thing here. Let's do that, right? Number one, we sweep. Number two, we don't tap into a fair value gap, but we tap into what's called a new week opening gap. And we'll talk more about this later. But essentially what I like to do, it's the closing price of the previous week and the opening price of the new week. But personally, what I like to do, I like to just mark out the void in liquidity. So this space, that's what I do, right? And you can see how we actually tap into that here. So we sweep liquidity, tap into a gap, and then what do we do? And then we invert something. If you follow this process, you're going to avoid a lot of silly trades. Believe me, right? You're going to avoid a lot of silly trades. Let's get another example. Okay, cool. We sweep liquidity. On the buy side now, we sweep a swing higher. Do we tap into something on the higher time frame? Well, look, we do. We have our 15-minute fair value gap. Great. We also come up here and tap into this one too. So we sweep liquidity, we tap into a bearish fair value gap, which again, they act as support and resistance. And then what happens? We break down and we invert this fair value gap here. Again, this on the 15-minute chart. The same happens here, look. All the best setups. We sweep liquidity first. We tap into that 15-minute fair value gap. And then what does price do? We invert the fair value gap. Now, if this is very advanced for you, I'd recommend studying this and then join the Discord like I've always mentioned, and post when I post about the individual videos in the forum, ask questions in there to the community because we'll help you out. And what this bootcamp is meant to do, it's meant to take you from A to Z. Yes, it's going to be in depth at some points. Yes, it may be basic in other areas, but it's about combining all the things together. It's not just a fair value gap. It's not just an inverse. It's not just a sweep. It's a combination of all these things that makes it A+ or a really good trade. And that's what a lot of people fail to recognize. A lot of people straight away, they jump into the PDRAs, they jump into the entry model, and they forget to look at market structure. They forget to look at these other concepts that are really, really important. And again, this is on the 15-minute chart, right? But you're going to see this in all time frames. And here again is another example. So we come down, we sweep liquidity, great. What's the next step? We tap into a fair value gap. And again, I typically just use the 15-minute chart. That is sufficient. And then there's a little inverse gap up here. That's all you need. And you're looking for this. Let me just mention this. You're looking for this on the 1-minute chart. What I'm going to outline is this. The sweep and the fair value gap you're looking for on the higher time frame like this. But the inversion fair value gap you can enter on a 1-minute chart. You don't have to wait for the 15-minute inverse. That's quite important. Right, that's quite important. So again, go back in time. We'll do a few more examples. What does price do? We sweep liquidity. Do we tap into a fair value gap? Well, there's a couple over here, look. We tap into a fair value gap. Look how we reject. Again, look at the candle wicks. Look what the wicks are telling us here. We came down, we're closing here. That's very, very bullish. And then what does the market do? We create a inversion fair value gap there. Let's keep going, right? We sweep and follow the markets, right? Follow the markets. We sweep liquidity. We tap into a fair value gap. And then what does the market do? We form an inverse fair value gap here. So this is just the bare bones, and this is the formation that you need, or the formula. There's no secrets that I'm holding. It's just how the market moves. Again, what do we see here? Fair value gap. We tap into it. What else do? We sweep liquidity, right? And then what do? We invert a fair value gap, right? Now, see how I'm putting the pieces of the puzzle together? We're at episode, 6 or 7 now, and already you should be trying to formulate how a model can form by using inversion fair value gaps, sweeps of liquidity, and higher time frame gaps. Let's keep going. All right, let's keep going. This market structure move, we sweep liquidity. We tap into this 15-minute fair value gap and we push higher. Perfect, perfect, perfect. Let's do a bearish example now. We sweep liquidity on the buy side. We tap into a 15-minute fair value gap, right? Then what does the market do? We form an inversion gap here. But if you look at this one too, there's many down here as well. And then we move lower. It's a formula, right? If you wait for these things, you're going to get very good trades. If you don't, you're going to potentially get wrecked in the markets. Again, sweep the sell side. Let's mark it out. This will be the last example here. Tap into a 15-minute fair value gap. Boom. And then what do? We push higher. When we push higher, what do? We invert this gap. So notice how you have to actually understand the market mechanics first, and then you can dig into other things, guys. It's not just about one or the other. It's about starting. You have to understand each PDRA, what it looks like, and then the combinations of those PDRAs that yield a profitable result. Now, I could use a breaker block, I could use a mitigation block, I could use an order block. We'll talk more about those in the next lesson, but this is just using an inverse. So an inverse is just the entry model. There's many, many ways to enter. This is just how I like to do it. So for homework, if you're curious, do what I did here. Do the same thing on a 15-minute chart, a 1-minute chart, and notice the repeatable patterns. That is your homework. And if you want to, post that in the Discord, in the forum page, post it underneath this lesson, which I believe is lesson 6 or 7, I believe at this point, 7. And this is what you need to do, right? So again, a bit of a longer lesson today, but this is how we're starting to combine the concepts together. We're going to combine more and more as time goes on. There's going to be a mix of psychological lessons, emotional lessons, risk management lessons, prop firm discussions, just general discussions and talks and chats. But this is also an important topic, right? And I'll leave you guys with it there. I hope you have a great week and all the best. If you're not yet in the free Discord, join that because we've got a great community there and you can post your questions there. We will respond. It's cool. Have a great week, great weekend, and we'll talk to you soon. Peace.